We're now in conversation with Ridham Desai, Chief Equity Strategist, India at Morgan Stanley. Ridham, great speaking with you, and actually great to speak with you a day after. When the dust has cleared, everyone sort of read the fine print and I think got a clearer picture of the good, bad and ugly of all things in the budget. So let's start with that overview. The day after is the LTCG cut looking not as bad, and all the gains expected from employment generation looking not as good. Is that safe to say?
Actually, there was great clarity yesterday itself. So I didn't really need the night to go to the fine print because there is not much fine print here. So there was great clarity yesterday, and that's why the market actually turned. Yeah, the long-term capital gains tax is not a big deal, though I have to admit that I didn't think it this way because I was always thinking the potential risk of 10 to 20, and I didn't contemplate 10 to 12 and a half, which is a pretty okay outcome for equities. And with regard to the stimulus for job creation, you're absolutely right. It is quite evident that we'll have to wait to see how things pan out on the ground. But if it does work, I think it's good for corporate profits. So on both counts, I think the clarity had emerged yesterday itself. So, and thankfully, there's not much fine print in the budget. So these days, the budget documents are far simpler than they used to be 10, 15 years ago.
When you'd see a little bit of red herrings across the way. No, fair enough. That point is taken. But just in terms of the impact for the rural theme, for bottom of the pyramid, for consumption, that's one story that's been going on for a while, was evident even during market close yesterday. Obviously, that sentiment has turned. Do you think that the whole story was overdone, and which is why you might not see that kind of excitement on staples going forward? I mean, of course, from an ITC, which is benefiting because of no cigarette tax hikes.
I think we should actually look at the strategy of the budget rather than going into these, very uh, less relevant nuances. So, if you look at it from a macro perspective, the budget has delivered a fiscal deficit that is lower than what we thought. Kudos to the finance minister for that, because this relentless focus on macro stability that this government has delivered over the past few years is what underpins this bull market. That's the key. So we have another commitment from this government that macro stability remains the key focus, and therefore the bull market is intact. At 4.9% fiscal deficit, 1.4% primary deficit, India is heading into a primary balance over the next 3 years. And of the large economies in the world, it will be the only one with a primary balance. As the finance minister reminded us, this essentially means that government debt to GDP falls, corporate debt to GDP rises, and corporate investments get crowded in. And that's the template to think about this market, about earnings, and about the macro. Everything else is not really relevant. The government did a lot of heavy lifting during COVID. And in fact, in the February budget, the message was very clear that it is stepping aside and now, hoping and letting the private sector come in. And rightly so for the government, because during COVID, private sentiment was very weak. So this budget reiterates that strategy that the government is now stepping away and the private sector needs to fill in both consumption as well as investments. The rural consumption was turning since February, and that turnaround is very much underway. So there's nothing in the budget that changes that. With regards to this expectation that this government will resort to populist spending, I think it was a misplaced expectation. And clearly, those investors who hold that opinion don't understand how this government functions. The government and the prime minister himself, they are inflation hawks. They're not out here to stimulate things and risk inflation. The key to exiting from poverty is to keep inflation low and keep inflation volatility low, which is what we have seen being delivered on the policy front over the past few years. And that also template remains. So if you ask me, is rural consumption doing well? Yes, it is doing well. Is the budget explicitly doing something to further enhance it? Really not directly, but indirectly by keeping macro stability intact. and rural growth will look much better in the next few months than it has over the past few months.
Hi, it's also Samina joining in, and I've got a counterpoint to what you said. So while we're all very excited about the fiscal glide path and the fiscal prudence that the government is focusing on, but do you think that could have come at the cost of perhaps a cut in expenditure? Because a lot of the government-dominated schemes usually have a booster effect. And I feel like while it's great, that 4.9% number looks great, but if it's coming in at the cost of expenditure, which will have a ripple effect, it may not be so great, no?
See, fundamentally, the government plays the role of providing counter-cyclicality. Okay. So when the cycle is down, the government comes in, steps in. Cycle down in the sense that when the private sector is not feeling buoyed enough to spend. So there are these times when the private sector restrains its spending because its outlook on growth is weak. That's what happened during COVID. So the government stepped in and compensated that. That counter-cyclical support has done its job. The economy is out of the woods. It's on a very strong path. We're the fastest growing economy in the world. There is not that much incremental role left for the government to do. Now the private sector has to take over. This is the recurring message that we're getting from the government, and it is absolutely the right message. If the government continues to stimulate the economy while the private sector is recovering, we will have inflation. Inflation will end the cycle. You don't want the cycle to end. So I think you must understand that there is no other country that has such precise policy responses right now. Such predictability of policy and such responses are not available. If you look at countries around us, they are all suffering from structural or cyclical issues which they are not able to exit. Not India, which is why the bull market is on in India and there's such a ferocious bid on stocks, and why we got a reversal intraday, despite the fact that capital gains tax went up, because it's noise. The real deal is that we have a strong economy with strong policy.
Ridham, good morning. And when I looked at your note, amongst the takeaways, the three key takeaways for the budget, maintaining of the capex momentum, there's a lot of, yesterday I heard a lot of comments about why is it that the number of the quantum of capex has not been increased. I thought it was a bit strange because only 8 months of the year left is only as much that the economy can absorb. Is it because of that, or is it because you are saying that the government wants to send a message to the private sector that we've done our bit, you do your bit now? The point I'm driving to is that this is for this year. Do you think the capex push from the government on the amount that is being doled out will progressively reduce with the years to come as the government tries to send a message to the private sector?
So, see, Neeraj, from the interim budget, the government had about 30-35 basis points to play around with because of the extra revenue boost they got from the RBI. They took 20 of that and put it in the fiscal deficit, and they took the remaining 10-15 and put it into some schemes around jobs, etc. So that's what they have done as a very simple explanation for what has happened in this budget relative to the interim budget. Now, we thought that maybe they'll take this 10, 15, 20 basis points and add it to capex. And we were not correct on this because the government has said that, we want the private sector to now do the capex. We have done our bit. So it's a very consistent message from where we were in February. Capex as a percentage of GDP from the government may have peaked in this cycle. And we may be at these levels of, say, 3.5% for a while, and maybe we even go sub 3 as you go forward, because how else are you going to consolidate the fiscal deficit? There are elements in the government's expenditure that are very sticky and cannot be contained because they're not discretionary in nature. Like you cannot cut back on government employee expenditure, you cannot cut back on defense. Interest expenditure is there, it has to be paid. So a lot of these expenditures cannot be cut back. So how do you bring the primary balance down to zero? And in large part, it will be from discretionary spends, some of it in the form of subsidies and some of it in the form of capex. So that is the roadmap ahead. And in the meanwhile, the private sector will step in and increase its own contribution to the economy.
Thanks, Ridham, in conversations with companies, because I mean, you might be talking to the very large ones and they are doing their bit on capex. I think what is missing is the MSME and the slightly small-sized companies coming out and doing the capex. Do you get the sense that the private sector capex will, which is showing some bits of fits and starts, will really steam up?
I think, Neeraj, that's the base case. You have to, so there are a few nuances around this. So let me just highlight what has happened in the last cycle. Private corporate capex to GDP was about 4% in the trough, went to a peak of 17 by the end of the first decade. And then from there, it declined to 4%, in Q2 of 2020 when we were in the depths of COVID. From that 4%, we kind of remained there for a while as we were dealing with COVID. The government lifted its own capex, and now we have come to around 5% of GDP. I reckon in this cycle, we'll probably cross the double-digit mark. So we'll go to 10. We're unlikely to go to the previous peak. And there are many reasons for this. One is that the nature of corporate capex has changed from the previous cycle. The corporate sector is not doing infrastructure spending like it did in the previous cycle. The second is, and this is, I think, one of the big changes that has happened in India and is not often discussed, is that capital efficiency in India has improved a lot in the last 10 years. So in macroeconomic terms, we use a term called ICOR, which is incremental capital output ratio, which is how much capital do I need to generate a unit of growth or unit of output. That quantity of capital has reduced. So we are more efficient as an economy, need less capital, therefore less capex. So that's the second reason. The third reason is that accounting of capex also has changed. A lot of companies are now charging what is in the nature of capex to their profit and loss accounts. So they're not bringing it to the balance sheet, and therefore the measurement has changed. So given all these changes, the likelihood is that this private corporate capex cycle peak may be lower than the previous one, but its contribution to growth will be similar because of the reasons that I mentioned. So I think we go from 5 to 10. It's very early days. I know we're all looking around for a full-blown capex cycle, but Neeraj, that is 2 or 3 years away. You will not ask this question to me in 2027 because it will be very visible to you that there is a lot of capex. Obviously, large companies started first because they have the stronger balance sheets and they have greater visibility, and then the smaller companies will follow.
Right. Ridham, just one quick question, and I want to try and understand on a specific news flow that came in yesterday. Mudra loans have got enhanced. We are seeing credit guarantee schemes for MSMEs, and that is going to go without collateral. So while this is a good thing for the lower end of the pyramid, consumption maybe to some extent, but I don't know how good this is going to be for microfinance companies. Do you feel like this news, while could work for consumption, may actually fail the banking side?
Actually, I don't think so, because we had great success with this scheme during COVID, and the default rate was very low. People don't default out of choice, they default out of compulsion. So it's only when things go wrong that people default. We're not at that point of the cycle where things are likely to go wrong. So the chances of a default are very low. So this support from the government is very welcome, because if there is any hesitancy from the banking sector to lend, such a guarantee will help them make that decision. And I'll tell you why there could be some hesitancy. The hesitancy arises from the fact that we have just exited from a very large NPL cycle just a few quarters ago. So people are still anchored to that NPL cycle and still scarred by it. Everybody in the system is. And therefore, such support is I think, important to allow people to overcome those scars and start more liberal lending. So I don't think it is likely to lead to defaults so early in the cycle. The risk of defaults increase as the cycle matures, and that's a few years away from India.
All right, so a lot of views coming in there. Ridham Desai, very, very bullish on the budget and all aspects of it. Says the long-term capital gains tax pinch is noise, as he puts it. Well, thank you so much, Ridham. Great to speak with you and hope to chat with you once again soon.